We've only got 45 minutes, and this is an hour-long presentation, so I'm going to kind of skim through a little bit of the intro. Reed gave a little background of how I trade, so I'm going to kind of go through that. If you want to know more about me or something, I've got an offer that you guys can come and learn all you want to about me and about the trading philosophy at the end. So real quickly, I was just born in a small town. You don't have to be in a big city. You don't have to be right outside of Chicago to trade for a living. I'm doing it from Virginia, which is one of the East Coast states, and it's a population of less than, I think South Hill's got less than 11,000 people in it or something like that, or it used to at least. It's growing, but we're nowhere by any means a big town or a big city or anything. I did graduate from Old Dominion, and I've spent 9 years in corporate America. What the 9 years in corporate America taught me was I did not want to be there for 9 more years. I loved the corporate, the ability to have entrepreneur spirit, and the company that I worked for actually allowed us within that corporate structure to treat our projects like we were entrepreneurs. So I don't have anything bad to say about the company, other than the fact that you have to get up every single morning. You have to go to work at 8:30, 9 o'clock, and you don't get off till 5:30, 6 o'clock, and your boss is dictating your deadlines. And that just killed me, because if I worked hard and I busted my tail, I got a paycheck, which was a decent paycheck, don't get me wrong. But if I did nothing and I skated around and I took 2-hour lunches, guess what? I got the same paycheck. And I'm the type of person that I didn't think that was too fair. What I wanted to do was, if I put in that extra effort, if I really killed it, then I wanted my paycheck to show that. And if you're a salaried employee or an hourly employee, it doesn't matter what value you bring to your business. Well, trading is the polar opposite. As a professional trader since 2005, when I put the extra time in, when I'm willing to take the risk, when I'm sticking my neck out on the line on the decisions that I make, when I'm investing in myself, when I put money to my education, it comes back to me in my P&L. And that's what I enjoyed. I don't like the glass ceilings, and in trading there is no glass ceiling. If you can figure out a way to get consistent, then all you have to do is you have to just keep growing and keep managing and using the leverage that the futures provide. So that's my philosophy. I've been doing this for, it says, an 8-year trading room moderator. I've been in this since 2005, so this is my 11th year. I was a couple of years into this when I really, trading, the one downfall that you have in trading is it's a lonely business. So the fact that you guys are here learning and investing in yourselves and investing the time in yourselves, it shows me that you're taking this seriously. But when you are a consistent trader, then guess what's going to happen? You're going to sit here by yourself, and you can become bored. You can become kind of lonely, or if you will. And so that's where I sought out to be able to teach and to be able to run a trading chat room, because if the markets are slow, we can talk about other things. And if the markets are rocking and rolling, then we can have a lot to do. We have a lot to trade, and it's nice to have people contributing and making money right beside you. But the other good thing is, from a moderator standpoint, is it makes me button up my setups. It makes my setups have to be crystal clear that when I take a trade, I'm accountable to other people, and there's no other place in this world that I've found yet that your decisions are put on display and you need to back them up. Because when I lose money, I've got to make sure my risk is controlled, because I don't know who's listening. I don't know who's taking the trades as well. So that's the great thing that I found about I guess the online community or the virtual community, is it gives me a sounding board. It gives me a place to feel like I'm part of a community, and that's the great thing that I've found. I don't have to do this for 8 hours a day or 9 hours a day. I can come in. I've got my little niche that I trade. I knock it out, and if I need, if I've got a little bit of more that I want to do, then I can put in some extra time. But I'm able to make a pretty comfortable living for me and my family, kind of focused in, and I get what all of us strive for. We only get 24 hours in a day. If we have to spend 9 hours or 10 hours a day working, that's that much time out of the day that I can't spend doing the things that I enjoy doing. And if I can come in here and I can make a full in 2.5 hours, or if I can do it in 30 minutes, then guess what? I've freed up my day. I've freed up my Fridays. I've freed up my weekends, or whatever I want to free up to do the things that I enjoy doing, or that I can do to help others, succeed in what they're trying to do. So it's an interesting lifestyle. Not a lot of people understand why they trade. They think they want to trade because they want to make big money. And the money is nice, but the flexibility is why I trade. And the flexibility to spend time with who's important to me, and this is who is important to me. This is my family. So like I said, I hate to gloss through it because they are the most important thing to me, but we're here to learn how to trade, so that's the quick introduction that I'm going to do. Again, if you want to know more about any of this stuff, we'll get to that later. The risk disclosure that I've got is real simple. I'm going to give you about 20 seconds to read over that while I just reinforce what we're going to be doing today. So for the next 35 minutes, we're going to be focusing on trading the index futures. What we're not going to be focusing on is trading gold or trading, Forex or anything like that, because in my experience, in my time in the markets, the one thing, and the previous speaker alluded to it, people can jumble up their charts with a bunch of different indicators. Well, you can also jumble up your charts with a bunch of different markets that you're not proficient in. So I want to get you proficient in one market or one series of markets that allow you to take income from while you learn additional markets. I'm not saying that the only thing I trade is index futures, but I will tell you that the index futures offer some things that the other markets don't to give you a little bit better edge for profitability. So now that you've finished reading the risk disclosure, hopefully, let's go ahead and talk about the index futures and see if we can get you that edge that you can start using tomorrow. So in order to look at the index futures, you have to, and now this is where I've kind of blown through the first part. Here's where we've got to get serious, and you've got to kind of pay attention, because the index futures, the Dow, the NASDAQ, used to be the Russell. I would shy away from the Russell a little bit right now. It's going through some fundamental changes. They're over the next few months, they're going to be, the CME, I think, is taking that back over. So be careful if you're trading the Russell. But the Dow, the NASDAQ, and the S&P 500, or SPX options, or ETFs, or anything like that, those type things are going to be directly correlated to what I'm going to teach you today. And the first thing we've got to understand about those vehicles is the pitfalls that you can fall into. So when we're talking about the indexes, this is the Dow on a 5-minute chart, and it's a day session chart. So the one thing, the struggle that I had in Forex is it would move at 2 in the morning. Well, where am I at 2 in the morning? I've just told you guys that the strongest part of my trading day or my trading profession, the reason that it's the most important to me is the flexibility. Well, if I've got to sit there at 2 in the morning and watch a chart because the chart's starting to break out, that doesn't sound very flexible to me. I like to be in the bed at 2 in the morning, and I've got 2 kids, which you saw in the pictures. They've got to get up for school in the morning. I don't mind getting up at 5 and watching the European Open, because I can work from 5 to 8:30 in the morning, and when they go off to school, I'm done with my work day. That's nice, and if you want to make that your work day, that's fine as well. But the Forex markets tended to, it's a 24-hour market, and there's an old saying in the markets, to be here for the good times, you have to be here all the time. And I don't want to be here all the time. I just want to be here for not necessarily the best of times, but I want to be here for the most predictable times. And for me, that's what index trading is all about. When you're trading the futures from an index perspective, you've got a window. The 9:30 to 11:30 window is the most active you're going to get in the indexes. That is the New York Stock Exchange Open, okay? And you can see by this chart starts at 9:30, okay? This is 9:30, 10 o'clock, 10:30, 11 o'clock, 11:30. So right here, if you look at this chart, that's where I want to make my money, okay? Now, there's a multiple setups available in here, and I'm going to try to, brief you on a couple of them that I use. but I want to show you how to figure out where these are going to filter the bad setups. And in order to do that, understand what the markets are trying to do. And they're trying to fool us. If this stuff was easy, everybody and their brother would be doing it, right? And what you're going to find out is they want to disguise the movement as much as they can so the least amount of people can participate. And now that's going to sound a little scary, right? The markets are out so that to quote unquote get you. The boogeyman's supposed to get you. And I'm saying that a little bit jokingly, but I'm a little bit serious. But the interesting thing is it's going to move when the least amount of people can participate. Because if it moved when everybody could participate, then, you know, everybody would do this. You would trade for 3 months and then you'd retire because you'd have made so much money hand over fist. So if the markets are out to disguise the movement, we've got to find those hidden clues that the market is telling us about in order to put us on the right side. Now, what I mean by that is, here's one specific example, and then I've got 3 others that I'm going to show you. You started off with a gap down, and those of you who are not familiar with gaps, I can expand on them at a later date. But basically, your gap 101, you know, your intro to gaps, this candlestick, the Serge talked about the candlesticks and where they're opening and closing. This is a hollow candle, so that means it's an up candle, and you've got a close right here. This is the 415 close of the previous day. This right here, since this is a hollow candle, this is the open, and that's the open of the next day. So if you closed right here and opened right here, we call this a down gap in the futures market or in the ETFs. We call that a down gap. There's a statistic that will tell you 83% of all gaps, whether it's up or down, are going to hit a half a gap fill, and that's just the 50%. That's halfway between where we closed and where we opened. And then above 60% are going to actually come back to the previous day's close. Well, armed with that information, you're thinking, well, wow, you know, this futures trading is pretty easy. All I got to do is when I see a gap down, I go long, and when I see a gap up, I go short. Well, that's great, but there's a money management component that comes in here because futures are leveraged. And what you've got is a lot of people get sucked in. Like I told you, the markets want to fool you. So when you get long here, goes your direction, and you've got a price target up here, you're fine while this candle's going up. And then look what happens. You get a big red candle. We talked about bearish engulfing. The previous presenter talked about bearish engulfing, right? And so then you're sitting here and you're thinking, oh my gosh, here it comes. There's no way this thing's going to go up to my gap fill. This is one of the 40% times that it's going to sell off, so I'm going to get out of my trade. Well, that's what the markets are wanting you to do. They're trying to get you wiggled out so that you don't participate in this move. Now, you see it pushes a little bit lower, stops out everybody that tried to go long right at the open, and then it turns around and goes straight to the half a gap fill. You put in a little uptrend, and about the time you say, oh, well, man, this thing's going to the gap fill, so you get long right here on another bullish engulfing candle, right? So you're like, okay, if it takes out the high of this candle, I'm going long. Well, what happens? You've got a price target here. The market reverses. Where is everybody's stops? Everybody's stops are right here below these tails, right? Because that's where the buying is going to come in, supposedly. So you can see how this chart, even though we knew it was going to open, it was going to go up to here, there's a lot of little pitfalls that would get you along the way. You can be right on your analysis. You can see that right here right before lunchtime, we actually went to the gap fill. But you can see there's 1, 2, 3, about 4 different places that you could have went long and probably lost money if you're using a stop. Now, I'm going to tell you need to use a stop. So I'm not advocating don't use stops. I'm advocating time your trades in the direction that you know you want to go. So let's talk about, and I'm going to get to the timing. I'm going to talk specifically about timing here in a second. But let's talk about a couple of other pitfalls that we're going to address and show you the secrets of how to avoid them. That's these oscillators. Here's the MACD, and again, I want to get through this as quick as possible because I want to show you how to make money tomorrow. So if I'm going too fast, they are doing a recording of this, and like I said, it'll expose you to a lot of this stuff, and you will be able to research it on your own or reach out to me after this presentation. I'll be more than happy to go in details on some of it. But when you got these oscillators that are sitting here and watching the price action, they're telling you whether price is getting getting a little, what's the word I'm looking for? They're telling you how much momentum the price is getting, right? Is it getting stronger to the downside, or are you starting to, is the selling getting harder and harder to take place? And what these oscillators are designed to do, what these indicators are designed to do, is to show you the turning points. Well, if you're not disciplined, if you're not, did you say don't use stops? No, absolutely I didn't say don't use stops. I said if you didn't use a stop, then you could have withstood the volatility, but you run a big risk of blowing out your account if you don't use stops. So I'm a huge advocate of stops. So we kind of see what kind of momentum is coming into the markets, and this is supposed to be a turning point. Well, look right here. Look at the time. It's 1:30, and we get a buy signal. You can see the green histogram, and again, I'm just using this as an example. If you bought right here, you waited 30 minutes, an hour, and 15 minutes. About an hour and 15 minutes, you bought the market. It made new lows. At some point, you've probably gotten frustrated in your trade, and you've given up on it. When you give up on the trade, then it goes straight up, and it goes in the direction, and you actually get that bottoming signal that you're looking for. Okay, so you are right in your analysis, and your timing was just off. So again, we're going to talk about the timing of these moves so that you don't have to sit through this for an hour before you can actually profit from the markets. And then there's the disciplined trader, if you will. There's the guy or the girl or the man or the woman who comes in and says, look, Michael, you know, I can follow a plan. I can do exactly what you tell me to. And we give them, you know, a 3-step or a 5-step strategy. And in simple terms, it's still using indicators. So you can't just blindly trade, you know, one specific thing. It's not a recipe. Like I said, if it was that easy, everybody would do it. There would be no need for 95 indicators in your charting package. If you only needed one, if you only needed the MACD, then why would we have all of these other indicators? But let's say that you're really disciplined and you say, okay, when I see this green histogram, I'm going long, and when I see the red one, I'm going short. Well, you get these choppy markets. Again, you get all of these signals, and about the time you say, well, man, this isn't a profitable strategy, look what happens with this green histogram. It stays long enough, and you get 7, 8 points in the market. So all of the little break-even trades that you took right here, 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 and here, you would have paid for your commissions, plus you'd have made a nice healthy day on this one move. But we would give up on the strategy. Why? Because the markets are going to go back and forth while we're disciplined, and then about the time we run out of patience, guess what? Other people are running out of patience as well. Everybody's throwing in the towel, and then you get the move because the least amount of people are going to participate. Okay? We didn't time the entry correctly. We got too emotional, and you know, we missed the move. Then there's the other saying. So we talked about stops. Somebody asked, did I say don't use stops? No, that's not exactly what I was saying. Other people are going to say don't do things when the indicators are overbought and oversold. We talk about, oh, if the indicator's oversold, the market's getting ready to bottom. Well, once again, if it was that easy, everybody would be able to trade from it. Look what happens when this indicator goes oversold. The market's just beginning its downtrend. So if these 4 examples that I've just shown you, if they're so wrong and so bad, then, you know, why are these indicators? Why is the CCI so popular? Why is the MACD so popular? Why are all these things so popular? Because if you can filter the false signals, these are great timing mechanisms of the market. We just got to know which ones to believe. So this downtrend, look at the CCI. There's also another, you know, view that, oh, when the yellow line on the CCI is below the red line, that's a sell signal. So you get a sell signal here, you get a sell signal. Look at this sell signal right here. How about that sell signal? And then you got, hey, how about this sell signal? So if we can figure out that the market is going down somewhere in this time frame, the CCI works great. right? It's not oversold. Well, what about if it's oversold and we use this as a sell signal? There's still some meat on that bone. So if we can filter a lot of these commonly used indicators to where we're not taking the up signals, we're focusing on the sell signals. And then we're not taking the sell signal or the sell signals when the market's showing an uptrend. Well, there are hidden secrets for you if you can find them and spot them, that you can shift this in your direction, okay? So I'm going to spend the rest of the time talking about those. I'm going to spend the rest of the time talking about the lesser known indicators and how to use them to gain an advantage, all right? We're going to start with the $ tick. There are two things. There are two secrets. Actually, there's like 5 secrets alone in the ticks, but we're going to go over 2 of them. We're going to go over the tick extremes and the tick ranges and how to make money using both of those. Now, I talked about the different indicators and how they do and don't give you the proper signals. The ticks it's not a price-based indicator. It's a ticker symbol of its own, and it's the value that represents the stocks trading on an uptick versus a downtick in the New York Stock Exchange. Now, I personally love the futures market because it's a leveraged market. You can make money really, really fast, or the flip side is you can lose money really, really fast in the futures market. But I'm not using the futures charts to actually trade them. That sounds crazy, right? Well, I told you these are hidden secrets. These are values that are gauging the overall strength and weakness in the market so that I can make my decisions based on the futures charts. So the $TICK, it's available on just about every charting platform out there, and it's going to show you an RPM gauge of the markets. It's going to tell you how much the market's revving, how much interest is it in the markets. Is it a market that, oh, it's just set on cruise control, you know, going through a little suburb at like 45 miles an hour? Or are you out on the Autobahn with the cruise set at 90? Or are you on a drag strip, you know, where you're going 0 to 200 for 3 seconds and then your car is going to blow up? Well, each one of those has different criteria for entering a trade. If you're cruising at 45 miles an hour, guess what? Your fib pullbacks are going to be shallow. The market's going to grind up and you're going to feel like you're paying higher prices than you should. But guess what? The market just keeps on going. If you're cruising at 90 miles an hour, it's going to be a fast market. It's going to be an intimidating market. And you're going to have to be aggressive to get in, and you're going to have to be aggressive to take profits. If you've got that drag strip, if you're pegging, you know, 10,000 RPMs and you're going for 5 seconds, you better watch out because that market can't last. That engine cannot last if it's turning that many RPMs. Okay? So you're looking for reversal patterns then. You're not looking for the market to continue at that rate of speed. All of those are completely different market conditions, and you can identify them by the ticks. So let's talk about what the ticks are. It's going to be a value that you need to worry about the key values. I told you the RPM gauge is there. Well, if you think of the plus and minus 1,000 as the red lines, okay, they're the red lines on your RPM gauge. It's where the motor's revving too hard, too fast, and it's not going to last. The 800, plus and minus 800, that's when the cruise control is already set. The object's in motion. The market is in motion. Okay? You're not accelerating up. You're already there and you're just trying to maintain. The 0 line is like your foot's off the accelerator, and that's your idle speed. When you're at the 0 line, the market can rev up or rev down, either way. So when I'm talking about the plus 1,000, plus 800, what I'm talking about is the difference between the stocks trading on the uptick and the downtick, and that's what the tick represents. You're looking at if you've got 2,300 stocks on the stock exchange trading on an uptick and 2,100 trading on a downtick. That gives you a tick reading of plus 200. So that's in between the plus and minus 800, right? So you still got room to go. You're still in an area that you can still benefit from. You can still make money at, right? Let's look at a couple of rules for the ticks. So a couple of rules for the ticks. If the ticks are spending most of their time above zero, you can focus on long-only setups. If the ticks are spending most of the time below zero, we're going to focus on short setups. And the extreme readings, we're going to fade those moves. So I'm going to get into that right now. I think a picture's worth 1,000 words. So let's get to the picture. Here's a tick chart. It's a 1-minute time frame. If you want the open, high, low, close is going to be on a 5-minute or whatever you want it to be on. The high and the low are going to be exactly the same. So here's how I set my charts up. I've got a line at -800 at +800. I've got a line at 0, and then I've got a line at plus and minus 1,000. Why? Because those are the levels that I talked about earlier in the chart or in the slide. It's where we need to know about in order to make money on the market. So we talked about some of those oscillators in the pitfalls of the trading, and we talked about timing your entry, right? So if we're trying to time our entry, do we want to pay? You see where the middle line is here? Well, that's where the ticks are going up and down. And that's where, if you're above zero, the market should have a little more strength than if you're below zero. Well, if we're sitting here and we get a sell signal when the ticks are at -800, are we getting a retail entry or a wholesale entry? And you're paying what everybody and their brother can get. So you want to wait for the ticks to come back up here. See this little downtrending channel that we've got? You wait till the ticks get there to the zero line. When they hook to the downside, that's where you're timing your entry. That keeps you away from getting in a trade to the long side or the short downside and the market going against you for 20, 30 minutes before it goes your direction. Okay? So we want to find the support and resistance on this chart and make sure it agrees with the turning points on the other charts. Let's look at it from a price example. I talked about the plus and minus 1,000 area being the exhaustion areas. Well, here's a chart that the market's been bullish. It's coming up. It's coming up. It makes a high. Well, look at what happens when it makes a high. You get to the 1,000 tick reading. That's exhaustion. This is timing the exhaustion. You can see the ticks have hooked to the downside and the market starts drifting lower. Where does it drift to? The -800 to -1,000 area, because that's where the market is going to get exhausted to the downside. Now, is that the absolute low of the market? No, it goes lower about an hour, well, 20 minutes later. But is that not the easy part of the move? Now, if we can grab that 25 to 35 points, that's $150 to $200 per contract in the futures market. And you just did it in about 20 minutes. So do you mind getting in, getting your money, and then getting out of the market? No, you shouldn't. Now, there's a lot more to talk about in the ticks. That's just one example of how powerful the ticks can be. Let's talk about a couple of more hidden secrets that you can use. Now that we know how to time the entry, now let's figure out which direction this market's going. And in order to figure out the direction, you're looking at the volume spread and the VOLD. These are the exact same indicator. It's the volume differential. This first one is just on the S&P 500. So if you're trading the futures market, you'll probably like that one more. And then this one is the NYSE volume spread, which, you know, they should be both correlated. Sometimes the S&P 500 is a little bit stronger than the overall markets. Sometimes it's vice versa. So I use both of them for confirmation. And basically what you're looking for is if this thing is straddling the zero line, you're going to get this type of price action, which is untradeable. Well, it's not untradeable. It's very risky trading because it works until the market breaks out. And that's always bad on your psychology. Oh, I'm going to take this, and then you finally get in one and the market breaks out and you're too late to the party, and then you're sitting there scratching your head. So when you see no trend on the volume spread or the VOLD, you want to focus on range-bound tactics. If you see the market cruising like this, if you see the volume spread in an uptrend above zero the whole day, well, guess what? These pullbacks are where you need to get positioned, because the market is telling you, it's giving you a hidden clue that, hey, look, I'm going higher. You can jump aboard or you can't. Here's 60 points right there. There's $300 available for you that afternoon just by understanding that the path to the market, the least resistance, is to the upside. There are more buyers ready to come into this market than there are sellers to sell the market. and that's a little misnomer. The buyers are going to be aggressively buying, where the sellers are going to be, not as aggressive. They're going to be a little more passive. Okay? So interesting. $ VOL SPD. Secret number 4 is the advanced decline line. This one's pretty simple. You draw 4 lines on your chart. Plus 1,000, and the ticker symbol is $ADD, and you put a line at 1,000, a line at 500, 0, -500, and -1,000. If the market is between 500 and -500, you're not going to trade this market very often. You're going to be really picky. You need a really an above average setup. If it's above 1,000 or straddling that 1,000 line, we're going to be looking for long signals. If it's below or piercing through the -1,000, we're going to be looking for sell signals. Okay? Now, I told you guys this was an hour-long presentation, so I don't have time to give you a whole lot of examples on the advanced decline line or anything, but at this point, I do want to bring today's chart in because it's a really interesting chart. What did we do today? Well, the ticks started straddling that 0 line. We could have gone either direction. This is a trade, and I did this in the room this morning. We actually, see, I told you guys about the gap strategy, right? We got long this morning in the trading room, and we had a target of 956 on the trade. Well, when we got here, we started buttoning up our stops, and as soon as this trend line was broken, we knew that the market was rolling over. So what I set up in the afternoon, I had to leave at 11:30 this morning. So what I set up is we drew this trend line about 11 o'clock, I think it was, after this point was put in, and we drew the trend line, and based on the internals, based on the fact that the internals were both sided and there was not really a whole lot going on, we said, look, if this choppiness, if this grinding action breaks, then you want the kiss trade. You want to let this break, and you want to short the retracement here. Well, I hope the people in the room were listening, because it paid off in spades for them today. Okay, now, where's the market going to stop? We hit this -1,000, right? Now, is that the dead lows of the market? No, but it's our trigger to start looking for a bottoming action. And this doesn't look like a lot, but if you're at the 20, let's say the 30 level, that's not the lows. If you started looking for a bottom and you got your confirmation signal somewhere in here, that's a quick 150 to 300 bucks, and that's what we're looking for. Now, you don't even have to catch that trade if you caught the little kiss trade that I told them about this morning, because that trade is a 940 to 740. That's a 200-point move. That's a $1,000 move in the market, and since lunchtime. So if you caught that, if we know this is exhaustion, where do you think they were using this -1,000 tick reading to do? What do you think they were using that to do? They were using that to cover their positions. Oh, so it doesn't always have to be an entry. It can be an exit. We know that the low-hanging fruit was right here. It was the kiss trade, and when you see exhaustion, you start covering. So they had from 780 to 740. They had that 40-point swing to cover their positions from where they should have been short right at the lunchtime frame. Really powerful stuff here to time your entries and exits. Okay, so that's a real life example from today, and you can see. People always think you kind of make this stuff up because we put it on slides, but I'm not making this up. Look at the volume spread. Do you think you knew the market was going lower? Look at the volume spread. Look at the VOLD. Do you think you knew the market was going lower? I can blow this chart up and look. Right there at 1 o'clock, your mind should have been shifting. We weren't very bullish. Now we're bearish because we're making lows and we're consistently making new lows. So even if you didn't get it till 2 o'clock, even if you didn't know that it was going down until 2 o'clock, you still caught from here all the way down. That's still a pretty good move. Still over 500 or 600 bucks. Really powerful stuff if you can pick up on it. And those, the 4 of the 5 secrets are what you can use to pick up on it. Now, the next secret is not related to this. This is related. I know that we've got some stock and options traders in here. So this is more of an option strategy here. And it's the ATR formula. And it's looking at the ATR in a little bit different light than what you're probably used to looking at it in. The ATR is the average true range of the market, and it's a calculation I just gave you right back here for you math wizards. Here's what you do. You take the previous close, you add and subtract the 14-day ATR multiplied by 20%, so 1.2. And that gives you your ranges, your upper range and your lower range. But again, you don't need to know that to use this thing. All you want to know is where the upper ATR is and where the lower ATR is. Now, why do you want to know that? Because other people are not looking at it. I told you guys, you want to look for things that others are ignoring or others are taking for granted. Nobody looks at the average true range of the market in this way. They look down here at the normal indicators, the average true range indicator, and they say it's 263. Oh, okay. Well, if the market's up or down 263 points, then, hey, we're at an ATR. Well, what do you do with that information? This visual says, okay, if the market is in a trending fashion, we're going to trade it in a trending fashion until we reach those levels. And then we're not, you guys have heard bulls make money, bears make money, and pigs get slaughtered. Well, we're not going to be pigs. When we get to these ATR levels, we're taking profits. There's no more meat on that bone for the day. So we're going to use that to make money, and we're going to switch from trend following traders when we get to these ATR levels to counter trend traders. Look right here. This is an example back in December. You got outside the ATR, you put on some option spreads. The previous speaker talked about credit spreads on the upside, like some call spreads. I like the put spreads and the call spreads because they're defined risk and they play off of volatility. So when we get here, we can do put spreads and we can look to cover them up here. This took 1 day. Now there's trades that took, this trade right here took 1, 2, 3, 4. It took about 5 days to get to max profitability. But we have this new thing called weekly options that have been around for a couple of years, and those weekly options work really, really well using these ATR levels. So when you're outside these ATR levels, the premium is going to be increased, and you're going to be able to put those spreads on for a decent premium, and once the market rallies back, you're going to be able to cover them really quickly. Okay, a couple of days is all you're going to be in these trades. 3 to 5 days max whenever the market goes outside the ATR. Those are swing trades that you're going to trade around your day trades, okay? So it's not going to tie up a futures account because you're going to be in options using this strategy. And those are the hidden clues that you can make money on starting tomorrow. And I've already shown you how they could have been used today in today's trade. There's a couple of things that I want to talk about as far as the offer that I want to make. So the first thing that I want to talk about is what I've just went through in the trading environment right here, and talking about the trading room that we do is a really, really kind of straightforward approach to planning out your day. We start with a gap trade. We know the gap statistics. This was a very profitable gap to trade. We made some decent money on it this morning. We knew what the conditions of the market were. So the next trades we looked for were the KISS trade here. We looked to cover at the extreme readings. If we were flat in the market, if I'd have got a -1,000 reading somewhere right here, I would have wanted to go long this market. I would, and it might have sold off just like it did today. But we take you through the day of the trading cycle. That's why we call it a day in the life trades for all market conditions, because no matter what the market's going up, down, or sideways, we're going to put a plan in place and we're going to trade it, okay? Normally these live trading sessions, if you do them, one-on-one with us or 5-on-1 or whatever, we charge about $300 for them, okay? We're going to I've got a special that's going to include a day in the life, a live trading session. Actually, it's 2 live trading sessions, believe it or not. We're going to give you immediate access to past sessions where we've made anywhere from, I've made anywhere from $40 to $760 in 2 hours while I was recording the sessions, and you get to see those. So you get to see multiple setups, multiple days of this stuff repeatedly working, and you get access to 3 of those courses immediately. They're $197 each. If you were to call us up, we would sell you this package for $197, the recordings, okay? We also give you the ATR indicator that I just showed you to use on TradeStation, and then we give you the code if you're technically savvy. We give you the code to take to a programmer or to get it programmed in other languages if you need it. We call it the pseudocode. I give you the formula behind the code in TradeStation so that you can give it to a programmer and they can code it for you for very minimal effort there. So all of that, it's $297 for the May 12th at 9 to 11. May 12th and the 13th. You get a link for the May 12th class. Don't tell anybody, but we don't change the link for that Friday either. So you get the May 12th session and the May 13th live trading room session. Normally we charge $297. You get the on-demand recordings. Right now there's 3 of them on your resource page that you'll be sent. And then the May 12th will be added to that as well. So there'll be 4 recordings that you'll get to use for pretty much forever. And then you get the ATR code. That's $591, all for $97 today. To take advantage of that, go to www.tradethesystem.com/go. And everything that we sell here at Trade the System has a 100% money-back guarantee. And guess what? You don't even have to make an excuse. You pay the $97. You come to the class on the 12th. If we make $1,000, if we make $500, if we make $10,000, all you have to do is tell me you didn't think it was worth the money. We'll refund your $97. Okay, you do. Now, I have had somebody sign up for it, and before we even did the class, they wanted their money back. So I kind of know what they were doing there. Guess what? I gave them their money back. I mean, I don't have a problem with that, but they did have to wait till after the class. You've got to tell me that you didn't get $97 worth of value out of the class. So no risk on your part. All the risk is on our part. We know if you attend this class, we know you're going to learn $97 times 3 or 4 or 5. And what our goal is to make you enough money to pay for the class and make it be a free class anyway. We can't guarantee that, obviously, but I will tell you that 4 out of the last 5 sessions we have been able to cover the cost of the class plus some. Like I said, one class we even made $760 right there in front of you, to pay for the class. Plus, the students were armed with trades that they could do every single day for the rest of their life. So it's kind of a no-brainer. If you want to learn about any of the strategies or anything, I've got time for a couple of questions, and I see at least one question, and then I'm going to have to wrap up because my 45 minutes is up. Does the ATR strategy need to be combined with the other 4? No, it's a standalone. It's when you're trading the option spreads, once you get outside that ATR, you don't need any other, it's a price-based statistical trade setup. It's going to have a very high win rate, and when it does not work, then yes, it is going to run you over. But it's if you design the trade correctly, and I'll talk about that in the live trading session, the way to manage your risk on that trade, it's a standalone indicator. But that's for the class only. You don't have ongoing trading. We do have an ongoing trading room. If you like that, if you attend the class, we'll be more than happy to get you on a subscription. We can do that.